The Bank of England has just dropped its latest quarterly financial stability report, and this time the message is crystal clear. The UK's risk environment has gotten a whole lot worse. Now, when a super cautious, conservative institution like the Bank of England says something like that out loud, the situation is genuinely worrying. They're pointing to a whole storm of global uncertainty. We've got geopolitical tensions, trade relationships breaking down, and governments around the world struggling with debt. All of this increases the chances of a major global financial shock. On top of that, cyber risks are getting scarier as the world gets more unstable. But the one thing they seem most worried about, it's the crazy valuations of AI companies. The bank says that share prices for AI companies in the US are getting close to the levels we saw right at the peak of the dot-com bubble. And here in the UK, stock valuations are the highest they've been since just before the 2008 financial crisis. In both of those historical cases, the market eventually crashed by about 40%. The bank is warning that a sharp correction, let's be honest, a crash is looking more and more plausible. So, why is this happening? Well, that huge wave of spending on AI infrastructure isn't coming from nowhere. It's being funded by rapidly growing corporate debt. This creates a direct, scary link between AI investments and the banking sector. If anything goes wrong in one corner of the AI world, the losses could spread like wildfire through lenders and investors in ways that are really hard to predict and could be catastrophic. Now, let's talk about the credit markets. On the surface, everything might seem calm, but dig a little deeper, and you find a familiar, unsettling picture. Corporate debt is high. The standards for lending are getting weak, and a lot of this lending is happening through complex, shadowy structures. It sounds eerily similar to what was going on right before the 2008 crash. The bank is basically hinting that all the old bad habits are back: sloppy risk assessment, unrealistic hopes for massive returns, and hidden dangers buried in complicated financial products. Two recent major debt defaults in the US showed just how quickly losses can hit multiple players all at once. Everyone is connected. Just like in 2008, one big failure can send a shockwave through the entire system. And what about the credit rating agencies? The bank implies they're too slow to react, which was exactly the problem back then when so-called high-grade debt turned out to be completely worthless. But here's a key warning from the report. This time, the real threat might not even be in the regulated banking sector. It might come from what we call the shadow banking system: private equity, private credit, hedge funds, and their associated insurers. These sectors have exploded in size since 2008, but they've never actually been tested by a major economic downturn. Even the Bank of England admits it doesn't have a clear view into what's happening there. In their own words, they're essentially flying blind. And it doesn't stop there. The bank also suggests that governments already burdened with high debt might not have much room to step in and save the day if a major crisis hits. Things like aging populations and increased defense spending are already stretching their budgets thin. While you could debate this point, the markets will take it very seriously. It raises the risk of a shock in the government bond market that could make any stock or credit crash even worse. And the UK is right in the firing line, given how deeply our financial system is connected to the US, Europe, and Japan. Because of these global links, a crisis in any major financial hub could spill over into the UK in a heartbeat. If banks start to panic, and we know they have before, they could trigger fire sales of assets and cut off lending at the worst possible moment. That would choke off credit to households and businesses, turning a downturn into something far, far worse. The bank insists that UK banks are resilient, but their stress tests don't really account for the shadow banking sector, where the biggest risks might now be hiding. As the report itself admits, having a strong regulated banking system doesn't protect the country if the unregulated part collapses. Meanwhile, what about the real economy? Small and medium-sized businesses, the real engine of UK growth, are still struggling to get the credit they need. The financial sector is busy taking risks that threaten the whole economy, yet it's not providing funding where it's actually needed. It is a total paradox. The system is behaving in a way that could bring down the real economy, while at the same time failing to support it. The bank also notes that on paper, household debt looks stable. But that's just on paper. In reality, households are incredibly stressed, especially renters, who are getting hammered by rising costs. In a crisis, landlords, lenders, and banks could all raise prices or rates, piling even more pressure onto millions of people. And here's another interconnected risk they've flagged. There's about £100 billion being used in hedge fund trades involving UK government bonds. If the AI market crashes, the ripple effect could hit those positions, destabilizing the bond market. The contamination between different types of assets is now so extreme that the bank says it coin. Then you have crypto and other financial innovations. The bank warns that crypto markets, stablecoins, and things like distributed ledger systems add another layer of uncertainty. None of these have ever been tested in a major macroeconomic shock. We've already seen how volatile crypto prices can be, and while crypto alone probably won't cause a global collapse, it could definitely make one a lot worse. Finally, the bank is acknowledging that climate change is now a direct financial risk, not just an environmental one. Wildfires, floods, and extreme heat are making some assets uninsured. This limits a bank's ability to lend against them, and leaves households and the government to pick up the tab. Again, they can see the threat, but they can't quite put a number on it. So, what's the real message here? Officially, the bank is saying the core banking system is strong, but risks are rising. But if you read between the lines, the message is much sharper. AI markets are a bubble. Shadow banking is dangerously over-leveraged and opaque. Government debt is fragile. Investment in the real economy is too low. Climate and geopolitical shocks are getting worse, and the whole system is tangled together in a way that could turn a small shock into a massive crisis. The tone of this report suggests the bank is deeply concerned. They missed the signs before the 2008 crash and were famously called out by the Queen for it. They do not want to be blindsided again. Their message, effectively, is this: we are in a period of extreme risk. A major financial crash isn't just a possibility anymore, it's looking increasingly likely. The only question is when. So, what do you think? Are you pessimistic or optimistic about the coming months? There's a poll below. I'd love to hear your view. If you found this video useful, please give it a like and subscribe. I've also put a link below to my blog where you can read the full transcript and find related posts, along with a ChatGPT prompt to help you write to your MP about these issues. If you'd like to support the work we're doing, there's a donation link below or on the blog too. Thanks for watching.